All right, everyone. It's that time of year where we're going to talk about the January effect and what that means and what it could potentially mean for our trading. Now, January effect is something that's heavily written about. And even though I'm not a huge seasonality guy, this is one that I pay attention to because it makes a lot of sense to me when it comes to tax. And it makes a lot of sense to me to kind of get a gleam into what the hedge funds and what the institutions, what the big guys out there are thinking. That's what we're trying to do, is we're trying to be able to get into these guys' heads and try to figure out what we can glean from them, because their buying and selling is going to dictate what happens to our portfolios and what's going to happen to the overall market. Now, we're just going to switch back and forth here a lot, I believe, just because there's not a lot of charts for this, but we're going to talk about the January effect. We're going to talk about reverse window dressing as well, and I'll explain kind of what that is. So, first of all, I just want to show the difference of this year's gain between the top chart, which is the S&P 500, and then this chart here, which is IWC. You could use IWM, but this is the micro caps. The small caps look just the same, if not a little bit worse. And what this shows is, if you've been living under a rock, is that large cap names have done fantastic. These small and mid cap guys, not so much, a little bit choppier, other than certain themes like space and quantum computing and all that kind of stuff. Now, what this shows is that we know where the tax burdens are lying for these institutions. They are going to be making money, and they need to then pay tax on money they make in names like Nvidia and Tesla and these large cap names. When these smaller cap names, they are not going to have to pay as much tax, or they're actually going to have tax losses. So that's where a lot of this January effect comes from. If you think about what tax loss harvesting is, tax loss harvesting is this thing in which if I have a gain of $100 here and a loss of $100 here, and I sell both, then I have no gain and I pay no tax. That's what tax loss harvesting is. So if I'm looking to sell something, I'm going to look at the stock that is doing the worst. If I have a stock that's hitting new all-time lows and it was just a bad pick for the year and it's just not doing well, I'm going to sell that, because then it's going to help with all of the tax gains that I've had this year. That's what causes a little bit of this effect. And that leads us into the first 5 days. And the first 5 days is very interesting to me, in which you have this kind of 5-day rule with this 83% hit rate. If the first 5 days of the year are positive, there's roughly an 83% chance, depending on where you start your counting, that the rest of the year is going to be positive. Now, there's a 75% chance that the year is positive anyway, right? But 83% of the time, you are positive. So why does this happen? To me, I think this makes a lot of sense when it comes to looking at the fact that if I am holding Nvidia right now, and right now, as of recording this, there's 2 days left in the trading year, and I am looking to sell it today, I'm going to wait until the new year, because then I just don't have that tax gain, that tax burden until next year. I'm kicking the can down the road. Depends on how aggressively I want to get out of Nvidia, or I want to get out of Tesla. Do I want out of these names, or am I just okay with holding them? If I aggressively want out, I'm going to start selling right as the new year happens, because I want out. If I'm still bullish on Nvidia, and I'm still bullish on Tesla, and I think these things are going to continue, then I'll just hold on to them and see what happens throughout the year. So how aggressive the institutions get in that first couple days when it comes to selling down these names in order to get that tax benefit or that tax burden at the end of this year, that's going to tell us how aggressive they are to get out of these positions. If Nvidia and Tesla and these names just get absolutely smoked in the first 5 days, then it makes sense to me that the rest of the year might not be a good one, because everybody was just kind of masking, pretending to be bullish by not selling anything until right when the new year switches and they sell. But the opposite is true. If they don't sell anything, if Nvidia doesn't get hit and Tesla doesn't get hit and all these big names just don't get hit at all, more of a chance to me that we're going to spend that new year or that other year being bullish, because it just showed us their hands, right? People can come out and they can say they're bullish, they can say they're bearish, they can put out their price targets of the year. What are they actually doing with their money? I think you see a lot of that in the first 5 days. And then that continues to the other January effect saying, which is, so goes January, goes the year. This is just the January barometer. Has a roughly 86% chance, we'll see here in a second, of not only predicting what the market is going to do at full year, but also what's going to happen in magnitude. So percentage chance that we're higher, and then magnitude that we're higher. We'll look at some of that data from Carson Research here, right here. It's actually right here. So I'm going to move out of the way. So the idea is that from this kind of 1950 to current, we have these stats. So right here, this is your average year in that at that time, right? This is your average year right in here. Right, so roughly the market's up around 8% a year, and it's about a 75% chance that the market's higher every single year. So that's our baseline stats. Now, if the January is positive, you're up on average 12%, and there's an 86% chance. So above that 75% chance. But not only that, a 12% gain as opposed to an 8% gain. So it's a big deal. It's 50% more profit on average for the year. And then you have a negative, right? If you have a negative January, you still have a 60% chance that you're up. So it's still better than 50-50 that you're up, but it's worse than the overall 75%. And you're only up on average 2.1%. Not as good. I'd rather 12% than 2.1%. And as somebody who runs systems over at Stats Edge Trading, if you want access to my system, come on over to statsedgetrading.com. Every weekend I send out, here are the symbols for the system. I do a lot of this work myself, even though I'm completely systematic in my trading. I do a lot of this work here in order to make sure that I am trading on the right side of the market. So these stats are very, very important to me. So positive January, way better than a negative January, which is not so fun. Now, what happens if we don't have a positive January and we don't have the first 5 days? Well, this is all the data that I could find. I couldn't find 2023 or 2024, but we kind of know what happens in 2023 and 2024. You can see any of the yellow is just saying you were up, but not very much, below average market returns. The green is your above average market returns of that 8%, and red is obviously you're down. So you can see if you don't get the first 5 days and you don't get the January effect, the odds are that you're going to have a pretty bad day. So we need to pay attention very, very closely to these. Now, the last part of the January effect that I think is important to talk to you guys about is this revision to the mean when it comes to different sectors. So last year we had mega caps soaring all year long. Mega caps just ripping. Micro caps, small caps not doing as well. But if the market is going to remain bullish, what generally happens is because at the end of the year, you have this bifurcation of the market because nobody's selling their Tesla. Because why would you sell it 2 days into the end of the year when you can sell it next year if you want to? But everybody is selling their names that are down. So if everyone's selling the names that are down, nobody's selling the names that are up. We have this kind of split that occurs. And you've seen that at the end of the year. Now, what will happen sometimes is that this will revert back. So say I don't want to sell all of my NVIDIA because I still like it, but I want to sell some. So I'll sell some of my NVIDIA, and then I will use that NVIDIA, some of those profits. Maybe I'll go back and I'll rebuy some of this stuff that I sold. Maybe I was in some psychedelic company or some genomics company or something that I believe has a chance to be a very good return, but it was down on the year, so I sold it to generate that tax loss. As soon as that window is done, that whatever the tax laws in your areas are, I'm obviously not an accountant, whenever those switch back, well, then I'm going back and I'm selling the NVIDIA a little bit and I'm buying back those names. So you can get this kind of revision where those large winners from last year end up coming down a little bit, and the ones that were doing bad last year end up coming up a little bit. That's what happens in bull markets. If they start selling everything and we enter this bear market, which that last slide for red reasons shows a lot of major pullbacks in bear markets. If that occurs, I think they sell the winners and they go to defensive assets, cash bonds, that kind of thing. If that bifurcation occurs, then that just makes sense to me that people are still bullish. What they're doing is they're using profits that they made from some of these big guys, and they're looking to buy, they're looking to hunt and peck in that mid cap, small cap area for what they think could be the winner into next year. So a lot of things that we're going to pay attention to, focus very much on. For me, this is more of a exercise of I want to make sure I know all these things. I want to make sure I'm focusing on the right side of the market so that I can stay ahead of everything so that when I give the algorithms, what the algorithms put out for uh, kind of recommendations. The algorithms look at, I have a pullback algo, I have a mean reversion algo, I've got a trend following algo. It spits out every week. We know all of the statistics. I show all on my website at Stats Trading, going back 20 years, what each month, what each year would look like trading these different algorithms. You can see it all there. But what I'm doing is I want to make sure that I am on the right side of the market. So I'm going to be watching very closely the first 5 days. I'm going to be watching very closely on January. If we don't get those, then it might be one of these moments where there's some algorithms that do better in choppier or bearish markets and some algorithms that do better in full-on bull markets. So it's just a weighting of where do I want to spend my time? Where do I want to put my capital? If you like this kind of content, wherever you're seeing it, hit the like, hit the follow. Go to statsattraining.com, sign up for the free email list so I can always email you every time I put out a video so you guys don't miss it. And let's pay attention to what happens the first 5 days and what happens in January.